Our next speaker, are thrilled to welcome back Stephanie Link. Stephanie is the Chief Investment Strategist, Head of Investment Solutions, and Equity Portfolio Manager at Hightower Advisors. As Chief Investment Strategist, Stephanie often works with advisory businesses and clients to help them navigate the economy and markets. The team that she oversees currently manages over $7.5 billion in assets. As an investment professional with over 29 years of experience, her insights are frequently sought after for industry events and by the media. You probably have seen Stephanie on CNBC as she frequently appears on the halftime report, Squawk Box, The Closing Bell, and Power Lunch. I know Stephanie runs about 10 miles on the treadmill and somehow at 5 a.m. is on Squawk Box. So I don't know how she does it, but she's amazing that way. As deserved, she has garnered numerous industry accolades, including being featured in Crain's New York Business as one of the notable women on Wall Street in 2022. Additionally, she received Savvy Ladies Award as a changemaker in 2023 and is recognized as a woman to watch by Investment News a number of times. Please join me in welcoming to the stage Stephanie Link.
Can I start off with a question? How much is the S&P 500 up year to date? 7. How much is the market up from the March 30th lows? 15%. The NASDAQ is up 21%. If you would have asked me in January where we would be today after Venezuela, SCOTUS reversing tariffs, AI taking over the world, ruining software in every industry in its path, private credit concerns, and war, I would have said you'd be down double digits. So why aren't we down double digits? Why are we up? 2 reasons. I'll start with the economy. The economy has enormous momentum. Pre-war, we were running at about 5.3% GDP. The average is 1.5%. We were running 5.3% pre-war. We dipped during war. We slowed down because of higher oil prices, a little more inflation, uncertainties, etc. But we've rebounded, and we're now running at about 3.7%. This is according to the Atlanta Fed tracker, which is something that I pay attention to. Basically, it's a computer, and it puts all of the economic data in one place, and it just spits out real time what the economy is actually doing. It's not precise, it's directional in nature. But 3.7% is still way above the 1.5% trend. So why are we growing above trend? 2 things. 1, the consumer. The consumer is consuming. And they are consuming because they have jobs. There's a lot of ways to measure jobs. I look at the weekly jobless claims, and I smooth it out over a 3-month period because no one wants to look at weekly data. And you're running at about 205,000 weekly jobless claims currently. Last week, we had 189,000 jobless claims. It was the lowest since 1969. That was the year I was born. So we have right now 1 job available per 1 unemployed person. That's pretty good. And what I have learned over the years is if the consumer has a job, they will spend. We are a nation of spenders, whether we have the money or not. But they do have wage growth. Wages are growing at about 4%. And if you switch a job, you can actually get more, 6.6% wage growth. Recently, we had some data with regards to spend. Retail sales grew 4%. Personal income and personal spending also is higher than expected. Real final sales to domestic purchasers, which is the true underlying demand, is up 2.5%. So they're spending, they're saving, not as much as we want them to save, but they're saving. Savings rate is about 3%. Better than the 1.5% that they had been pre-COVID. So the consumer's doing well, and the consumer's actually spending on the right things that we want them to consume. Services. So restaurants, hotels, airlines. I don't know. Was your airline packed yesterday? Mine was, certainly. Airports, that kind of thing. Services is 75% of consumption. So this is what we root for. We root for the consumer to do well, to spend, and we root for them to spend on services. So that's going pretty well, knock on wood. The other piece of it is AI. It's not just AI, though. It's not just Mag 7 spending $800 billion this year on AI CapEx, up from 400 last year. It's more than that. It's what I call the AI food chain. The AI food chain is, if you believe in AI, which I do, I think you're in second innings, you have to believe that we need more data centers. We do not have enough data centers. We have 11,500 data centers right now in the world. We need to get to 30,000 by 2030. If you believe that, you need an upgraded grid, and 75% of the grid is over 25 years old. And if you believe that, you need power, and we just don't have enough power. And it's going to come from everywhere. I personally think natural gas is going to be the winner, but coal, nuclear, some parts of renewables, but we don't have enough power in the world to fuel all of this, which in a way is a good thing because it'll slow down the adoption rate. And I think this is a very, very, it's a powerful, pun intended, it's a powerful theme for the long term. I think this has like a couple of decades to it. But why I mention it is because it is such a tailwind to so many different industries. Think about not just the technology companies that are spending all this money. It is also the industrial companies, the companies that make cooling systems, heating systems, semiconductors, so that the semiconductors don't warp inside the data center. It's the grid, right? It's owning companies that are helping to modernize the grid. And then finally, it's power. So it's all of these industries that are helping our economy. And in addition to both of these things, we have the one big beautiful bill. Whether you think it's beautiful or not is a debate, but that's going to add 1% to growth as well. And I think that's one of the reasons why, in the face of higher oil prices, we have been able to do better and the consumer has been able to hang in there because of the whole, the tax refunds and that sort of thing that's happening within the bill. Why do we care about all of this? Well, we care because I say it every year, earnings, the implications to earnings is substantial. So the long-term growth of earnings is about 5%. We are lucky because we're in earnings season right now. And so far, we are running 28% growth, driven by everything I just said. And it's not just earnings. Revenues are running up about 11%. And what I find very interesting, and something that I've been talking about for a while, but I'm glad it's coming true, is margins. We're actually seeing margin expansion in the face of higher commodity prices, in the face of higher everything prices. Companies are adjusting and adapting. And I will say this again, the thing that matters the most in the markets is profits. Stocks follow profits. And profits are getting revised higher. Stocks will follow that. So last 3 years, we had great returns on the overall S&P 500, 18%. The year before that, 24%. The year before that, 23%. And that's because earnings were actually going higher. But the rate at earnings today, how they are going higher, is much faster. So I don't know if we're going to be up another 18%. I was thinking maybe 10 to 12%, but the implications from AI is enormous. Now, I worry about a lot of things, so nothing is ever perfect. We have a new Fed chair. There's no way they're going to be able to cut rates with inflation where it is. We'll have to see, play it out. We have high inflation. Can we get that down? We're at 3.5%, but we're not at 9%, which is where we were in 2022. We are making progress, and the good thing is we're seeing better productivity. And productivity is a wonderful thing for inflation. So productivity, in fact, we got productivity numbers this morning that were much better than expected. And that has everything to do with AI and technology. So it all kind of feeds into itself. And of course, I'm going to be 100% wrong if this war is years and not months. I think it's going to be months because I can't imagine that the Trump administration wants to go into the midterms with gasoline prices where they are. There's a lot of other reasons why I think that it'll be months versus years, but this is just an unknown. We don't know. So that's my thing about the markets and the economy. I feel pretty good, but I do worry about a lot of things, and I think that's kind of healthy. The way I invest is I do spend a lot of time on the big picture, but then I focus on themes, and this is what the slide is. I focus on themes that have longevity, like 10, 15, 20 years, not just a year or a shorter period of time. Because if I feel strongly about a total addressable markets and the growth, it doesn't matter if the market does this. That's actually your opportunity. When the market is down, if you believe in these themes, you find stocks that participate. We already touched on AI and the food chain, but that is by far my most favorite. It's just very popular at this moment in time. I do think there's better value in some of these industrial companies, as I mentioned, the companies that are actually building the picks and the shovels, and some of the utility companies, and of course, the grid manufacturers. That is remarkable. So those kinds of growth numbers that we're seeing, we're used to seeing that in technology, not in industrial companies. So I think that's definitely a place to invest. And I will say, if you have time and interest to listen to the CEO of NVIDIA when he talks about the 5-layer cake. The 5-layer cake is applications, models, energy, chips, and infrastructure. That's the foundation of all of this AI. That's where you want to be investing. $90 trillion was his number, not mine. The second theme is cybersecurity. You've heard me say before, I think cybersecurity is bigger than AI because of AI. We have companies that now are building code using AI. 50% of the coding is being used by AI. Think about that. That in and of itself is not safe, not secure. And I will tell you that there are still a lot of companies out there that don't offer a lot. So you're going to see massive consolidation. We still have 4,000 companies that are either public or private, and I think you're going to see massive consolidation. We saw 400 deals last year. We had 8 deals that were $1 billion each. We had Palo Alto Networks that actually spent $30 billion in M&A in just the last 6 months because they want to offer more to their customers. Their customers don't want to use 25 vendors. They want to use like 5. So the global cost of crime is $10.5 trillion, up from $3 trillion in 2020. Let me give you some other numbers. To me, it's fascinating. The costs. Business disruption costs businesses $1 billion a year. Direct financial loss from a crime is 150 to 250 billion a year. Data breaches are 10 million per incident. Brand damage, 100 billion, and identity theft, 27 billion. That's an area, by the way, one of the areas where Palo Alto actually made a very big acquisition is an identity. That's a big one. The reason that the cybersecurity companies didn't do well last year, and they're still not doing that well this year, is because they're getting kind of thrown out with the baby with the bathwater on the whole software is dead theme. And cybersecurity is not going to be displaced by AI in any way. I mean, listen to any of the CEOs of cybersecurity companies. They will tell you the exact same thing. You can't replicate it. Speaking of software, that's my third theme. And I would say some software, SaaS models, pricing per seat, they're going to struggle. These companies are going to have to transform themselves to need more price per consumption. But if you don't want to get all in detailed in that kind of who's winner, who's a loser, find the mission critical companies. Find the companies that produce software where companies can't exist without them. What do I mean? Electronic design automation. Their software produces 50% faster knowledge, 50% faster workflow, and 5 times faster in testing. They help the hyperscalers and the custom ASIC companies scale. They can't scale without their software. And it's about a $2.3 trillion total addressable market. Just think about the companies that have to find this kind of software. Banks, the government, utilities, healthcare. And these companies have about like a 75% recurring revenue. Next theme is robotics. It's up there in terms of one of my favorites. We have 4.7 million robots in the world today. We're going to get to 155 million by 2050. Think about that. Amazon has 1 million robots already. They think they're not going to have to hire 400,000 people between now and the next decade because of the robots that they have in place and the productivity. And they're already seeing $2 billion in sales in terms of cost savings. There are 3 types of robots. So it's brains, bronze, batteries. That's the way I remember it. Brains, the intellect. Bronze is the motion. Batteries is the power, which we don't have enough of. Here we go again. By the way, speaking of Amazon, if you have some time, read Andy Jassy's shareholder letter. He's the CEO of the company. If you want to understand more about AI and all the heavy investments that they're doing, he just wrote a letter to the shareholders, and it was a great, great letter. I learned a whole bunch. And he basically was saying, yeah, we're not getting a good ROI on our spending right now, but just wait. And he has said many times that AI is something that he's never seen in his lifetime, we've never seen in our lifetime, and the implications. So it's worth a read. Rideshare is the next one. It's a $30 billion market with a CAGR of 10% per year. But this is a very big market with a duopoly and a ton of spending. We're going to go from 30 billion rides per year to 50 billion by 2030. And last year alone, we spent $190 billion on rideshare. And a lot of that is because of on-demand mobility. Crypto. I know there was a question on crypto earlier today. People think it's a store of value. I just kind of think about not my generation, my daughter's generation, Gen Z, and where they are investing. And they are investing in crypto. In fact, my daughter has said she'd prefer to invest in crypto than stocks. So I told her she's not allowed to come home. 51% of Gen Zs own crypto in some way, shape, or form. And I think what's really, really important is there is this huge generational transition of money, of wealth coming. $140 trillion between now and the next 25 years. It's going to go places that are not here. It's going to go to women. Women are going to have to learn how to do more investing. It's going to go to Gen Zs and then Gen Alphas and that sort of thing. And I pay very close attention to that kind of thing because it really matters, the demographics. Now, I think it got popular in terms of more popular overall, crypto did, because you have 100 ETFs and 100 more have filed. So it's going to gain even more in popularity. Next theme is commodities. I would focus on copper. We're actually seeing new highs in copper. It's really all about the global demand. They call it Dr. Copper for a reason, because it goes into everything. But if you believe in electrification, which we just talked about, if you believe in EVs, if you believe in housing, which I do for the long term, we're in a little bit of a slump right now because of interest rates, but I do believe housing, we have a shortage, and that's the number one commodity that goes into a home. And of course, it's also about battery storage. It's really hard to get copper from the ground. We have a deficit right now of 330,000 metric tons. In the next 10 years, we're going to get to 7.8 million deficit. That's huge. And it's because it's hard to get. But I do believe that if you believe in all these other things that we're talking about, Copper is going to certainly play a big, big role. The next theme is the creator economy. So think of influencers on digital. Any of you have kids, you probably know that they follow influencers on TikTok, on Instagram, YouTube, etc. You have 67 million influencers today. That's growing at a CAGR of about 10%. And they're gaining market share with the advertisers. They get a 26% advertising lift from an influencer versus a traditional media company that gets about a 6%. Consumers are just shifting their behavior, and they are focusing on this whole cohort, and they're actually listening to them. And this, again, is mainly Gen Zs, but 52% of Gen Zs have actually bought something that an influencer recommended. 60% of Gen Zs believe that influencers are better to be believed than celebrities. They trust them more, whether they're right or wrong. And 75% of female Gen Zs have learned how to apply makeup. Seriously, I mean, it's crazy. Next, Brazil. I'm a big fan of Brazil. They have 214 million people. It's the seventh largest country in the world. It's the largest Latin American country. The average median age is 35. They have very high interest rates, but those interest rates are starting to come down. They have a fairly new government, and they are doing things from a fiscal and monetary point of view that are very beneficial, that will help them grow above average. Most people think it's an agricultural kind of country. It is. 23% of their GDP is agriculture. But what I find really interesting is they have something that we all want. They have power, and they're going to benefit. So this is a hidden way to play that theme as well. And then lastly, quantum computing. 2029, 2030, that's when we're going to start to get all the rage of quantum computing, but many companies are already preparing for it. This is AI on steroids. They can solve complex problems in seconds and minutes versus days, hours, weeks, years. And it's also going to drive a whole new hardware upgrade cycle too, because it's a totally different operating system. So really, really powerful stuff, and something to watch. So then lastly, I have up here Peter Lynch. You know who Peter Lynch is? Yeah, he was a pretty successful portfolio manager at Fidelity Magellan. From 1977 to 1990, he had a compounded annual return rate of 29.2%. That's actually better than Warren Buffett. Why do I bring him up? Because I learned so much from him just by keeping it simple. He said, invest in what you know, invest in what you see, invest in what you experience. That should be your first screen. And he said, don't sell his biggest mistake, selling his winners and buying his losers, or holding on to his losers. He said it's like cutting the flowers and watering the weeds. Makes sense, right? I mean, that's kind of cool. Okay, well, thank you very much.